My name is Michael Gayed, publisher of the Lead Lag Report. Joining me for the hour is Mr. Peter Atwater, who I had on a space, I want to say a year or so ago. So a lot's happened since then. Peter, introduce yourself to the audience. Who are you? How'd you get involved and interested in psychology, behavior, markets, and what are you doing currently?
Sure. So I guess in the middle of the financial crisis, I spent a lot of time looking back at prior financial disasters and became interested in the underlying psychology of manias, and then tried to figure out, well, how do you use it, and try to come up with a framework for knowing when are you at major bottoms, major peaks, and that sent me down a whole bunch of different rabbit holes trying to look at confidence more broadly. And so I've spent the last decade really studying confidence, what it is, how it affects us in so many different ways that we underappreciate. And at this point, I teach classes on it. I do consulting to business leaders and investors, and that's how I spend my time.
So I've made that point before, Peter, that arguably the one commonality that major tops and major bottoms have is overconfidence. And that term is used quite a bit. And it's one of those terms that's hard to exactly quantify. It's like, what's the differentiator between somebody who's confident versus somebody who's overconfident, and then applying that to the crowd. How do you think about that distinction between confidence to get an act done versus the overconfidence, which creates maybe too much risk taking?
So the way I look at it is sort of in the opposite direction, which is to say, and we don't think about it this way, the opposite of confidence is vulnerability. And so when we are overconfident, we have essentially allowed ourselves to tell ourselves stories in which we are not vulnerable. And so there are two aspects of that. One is that I feel things that are incredibly certain, that I have no doubt what's ahead. And the other piece of it is related to control. And that is that I think that I have far more control over the situation than I really do. And where we end up in our worst position is when we combine those two and we think that everything is going to go according to the way we imagine it to be, and I can control that outcome. And we see that with investors, especially. And to your point, it's the same behavior at the top. At the bottom, what happens is just that vulnerability overwhelms us, and we have to do anything that we possibly can to regain a sense of certainty or control in our lives.
So it sounds to me like from an overconfidence perspective, those that are overconfident are really overconfident about their ability to forecast what comes next, whereas those that are maybe just confident are more confident in their ability to deal with whatever future comes. Is that kind of a fair distinction? Because I do think there's an element of forecasting that has to be discussed in this construct.
Yeah, absolutely. And I think it's really important to suggest, to say that there's no such thing in my book of a forecast. It's an imagined future. The world is inherently uncertain. It always has been, always will be. And so what changes is our imagination of that future. That when I am confident, I imagine a positive, rosy, impeccable outcome. And so we have to be careful, and it's a measure that I use a lot with people, to say anytime we ascribe more than even odds to an outcome, chances are we're expressing more about how we feel than we are about the reality of the future ahead. If I imagine that this is really going to work out, all I'm really telling myself is I feel really confident, because the odds of something working out are no better or no worse than they've ever been. So I just think, anytime you're entering into something, whether it's a trade or a contract, or, just remember that the more certain you are, the more that certainty is reflecting how you feel versus what's likely to happen ahead. And the same at the other end. I mean, if I don't think there's any chance in something working out, that's my underconfidence speaking more than the reality of the situation.
I love that term, the imagined future, right? Because that's often what results in leverage, bubbles, crashes, and that cycle repeating. And I don't think you've ever really had a period in history where there's been a bubble in something that has fundamental underpinnings, right? Where the price to book is low, because why it wouldn't be a bubble in that case, because the price to book is low, right? So presumably part of that idea of imagined future relates to not having anything to anchor valuations on.
Yeah, I think that we have had fabulous bubbles in things like railroads and canals and things like that, where there was definitely utility. But what happens is we imagine the future to be bigger, bolder, and sooner. That what happens with all of these things is we expect things to happen far faster than they really will. And so that acceleration, that gross overestimate of quantity, those things then get filtered into estimates that we then ascribe insanely high multiples to, and the result is the valuations that we see.
So I think that's a good starting point to talk about what's happened the last year and a half to the cryptocurrency space. And for those in the audience, the objective in this space is not to attack anybody that's invested in cryptocurrencies, but rather to look at what's happened over the last year and a half as a case study around something which happens repeatedly, which is this idea that there ends up being this almost cult-like belief in a particular investment, which inevitably kind of falls on itself. So I want to hear your take on the psychology of what got us to where we are today in the fall of, at least for now, the entire cryptocurrency space.
Yeah, and I'm going to be very clear. I'm agnostic to crypto. I have at different points been bullish. I've been at different points bearish. I frustrate people because they want to put me in a box of you're a bull, you're a bear. It's like it depends on the day of the week. So having said that, I'd like to roll back the time to the fall of 2020, because to me, that's really where we see this bubble phenomenon truly accelerate. And it's important in a dimension of what I think of as abstraction. When we are not confident, we need things to be tangible, real, concrete. There's a demand when we're vulnerable to sort of cut the crap and just things have to be real, or they don't exist. It's why we need to hold physical cash at lows in extreme lows in sentiment. So what we saw coming out of the COVID experience was this insatiable demand for abstraction, things that were futuristic in time, things that were sort of out of this world in terms of space and physical distance, in terms of social distance, and then in terms of their hypotheticality, the possibility, this endless possibility in these dreams. And there was just a unbelievable need that people had to own all of them at once. And so you saw this simultaneous, land rush into anything that was a dream, that was all about possibility, about the future, and manifests in things like SPACs, in meme stocks, in crypto. And it then became this frenzy of offerings. If you could create it and sell it and throw it against the wall, somebody would buy it at whatever price it was. And so I assign a peak to the abstraction bubble in terms of time, almost now 2 years ago. You had Lordstown Motor with a fake truck. You had all of these different sort of out of Hollywood casting, bold imagination of the future. And you saw different individuals caught up in that. You saw different companies caught up in it, different products, but it was all under a Venn diagram that rotates around the word dream, possibility, abstraction. And if we stop and say that was the top in terms of investor sentiment, what we've actually seen is an incredibly logical, consistent with history unwinding of a extreme sentiment position and confidence back to lower and lower levels of confidence. And I've said this before, bubbles unwind on a LIFO basis. The last things that we rush into become the first things that depart violently from a price perspective. Demand exhausts. And so I can create a very logical, organized timeline between the beginning of 2021 and today. Again, the major indices, the things that were less abstract, well, of course they wouldn't peak then. They would still take time for those to peak, which is why you have almost this year-long rise in the broader indices. But if you step back, the cast of characters, the instruments, the things that have folded first were the last things that investors rushed into and have paid a hugely punitive price. And what we're seeing, and we saw this in mortgages, remember subprime mortgages went first, then all day, then ultimately prime, is as investor confidence has deteriorated, more and more less abstract things are coming under question.
Yeah, no, and it is fascinating. I mean, listen, I was seeing a lot of the silliness and mocking a lot of the narratives all the way in the advance and the decline, and it is amazing to me because it's like I was just looking up because I was trying to remember exactly the number, but there was the story back in February of this year where the headline is someone just paid $450,000 to be Snoop Dogg's neighbor in the metaverse, and it's like you see that. I don't feel like you need to necessarily be experienced in the business of investing to look at that and say that's a clear sign of a bubble that's not going to last. Yet people really did believe, to your point on the imagination part, that all of this these digital assets, all of this virtual world making, that would be how to get rich quick. And it's just amazing to me how this is not to me even something that was obvious with hindsight. It was obvious then at the moment.
Yeah, the challenge is that our stories, our level of confidence, and our actions all exist in equilibrium. So if I'm caught up in that environment, I am going to have a really hard time looking at it objectively because what I'm doing, how I'm feeling, the stories I'm telling myself are, I live in my own personal echo chamber, particularly at extremes in confidence. And so it's impossible to tell someone who is overconfident that they're overconfident, and I can't tell somebody who's underconfident that they're underconfident. They're just that we're going to push back against it. But I would also say, Michael, that as much as we may see devastation in different parts of these products of imagination, to me, there's still an awful lot of optimism out there. That the sense that things will return to the way they were is still remarkably high. And what's wild to me, and I think I'm going to go back to 2020, that the end of it is, people have asked, what's if you had to choose a single word to describe the environment as this stuff was peaking, what word would you choose? And the word that I keep coming back to is Caligulan. There is a sense of such extreme behavior that it at times bordered on grotesque. There's also a whole lineup of emperor-like figures that really dominate this whole environment. And as I wrote in the Financial Times a couple of weeks ago, this has been truly a field day, sort of the salad days of storytellers. That folks who could hype dreams have been the most successful figures on earth.
I wonder how bots factored into that. And I know that sounds like a strange question, but I do believe that a lot of the spreading of of those stories, the storytellers need an audience, need retweets, need likes. It seems to me, because I remember very well how people were tweeting, or maybe bots were tweeting, it seemed like there was almost coded insanity in the things that were not only being said, but then being spread. How does technology and maybe the proliferation of spreading misinformation factor into the confidence aspect of bubbles, coming into existence?
So I think that the technology to me does a couple of things. It adds speed and it adds volume to it. And that's nothing new. Radio did it in the 1920s. The telegraph did it in the 1850s, and television in the 1960s. And so we can ascribe it to bots, but I think we need to just look at social media, the interconnectedness of communication today, to say what that's done is enabled things to move far more quickly to far more places in far more volume than ever before. And I think that we really saw that in the hockey stick shaped lines that just dominate price charts from 2 years ago on the way up. And I think we also have to appreciate that we've seen the same effects in those same hockey stick drops on the other side. And that's to me that's a risk that I think investors, regulators more broadly underappreciate. Some of the financial crisis porn that I read 15 years ago, the panic of 1857. Who cares? Well, you should care, because it was historians talk about it as the fastest moving crisis up until that point. What made it different from prior crises was that instead of it taking months to play out, it took weeks. And you say, so why? And so, well, the telegraph. And you can see the same effect with radio and television. And so I think we have to brace ourselves and recognize that the mark to market of sentiment today is instantaneous, in enormous volume, in global proportion, every moment of every day.
And part of that also is that it prevents people from actively thinking. And I saw the tweet you put out about crowds with System 1, System 2. I'm a big fan of Daniel Kahneman's work. I mean, everybody. I always use that line that amateurs look to the right of the equal sign, pros look to the left. And social media has made people, and arguably just Google, right, has made people so used to getting the answer as opposed to thinking in terms of what gets you to the answer, that maybe it prevents the crowd and individuals to think critically about whether what they're putting their money at risk in is a bubble or not.
Yeah, the reaction is now the news. I mean, there were a couple of months ago, I forget what the economic statistic was, but the news story fascinated me because it wasn't the statistic that became the headline. It was the impulsive response that became the news story. And it was that response that then drove subsequent behavior of the day. So to your point, what's happening is things are occurring, and now the crowd is responding to the reaction that all of this computerized trading is undertaking. And so it's like, wow, if the computers felt that violently, then we must respond in turn. And so what you do have is this amplification effect over and over and over, and it's amplified in both magnitude, but amplified in terms of the density and timing. Things are happening just that much faster. The gamification, the gamblification. I mean, we're gamblifying everything, and I think that's again a very consistent peak in sentiment behavior. The concern I have is we need to be honest that if the crowd can think that everything can only go up, we need to be honest that the crowd can also come to a point where they believe not that things can only go down. So I think we have to appreciate that in an environment where people are gaming black or white, we could see, and we saw this a couple of months ago in the put option, the daily put option volumes. But I think the crowd can just as easily move to thinking things can only suck in the same way they think that things can only go up. It's funny. I don't think that people are necessarily bullish as far as positioning. I think it's just where and how can I make the most money the fastest. That's the motivator in the behavior right now.
So I would argue that makes it in some ways easier to be contrarian because you can identify it more clearly. I mean, for me, as somebody who's and I'm loud on Twitter because that's the persona that gets engagement. Okay, fine, but I've used that. I've made that point before, right? You're right when the counter argument is an insult, and it part of this overconfidence discussion also relates to the idea that people kind of lash out not on the process or on the conclusion, but on the person giving the message. That to me, I know that's always been a dynamic in human history, but it seems to be so much more prevalent now. And again, maybe it's just because of Twitter and maybe it's just this little domain here, but it makes it easy and hard to be contrarian because on the one hand, you can see where the crowd's leaning. On the other hand, if you even try to note that, you get vilified.
Yeah, and I think you just have to, appreciate that. Twitter to me is an unbelievably valuable resource in looking at sentiment in real time. It tells you within seconds where the crowd is. If you want to, create a stampede of abuse, put something that is, to your point, that runs counter to the crowd, and then watch what happens. I just prefer to just watch. So
I prefer not to watch, but I don't want to be like that. But there's an interesting kind of, I think, feedback mechanism that comes from that too. On a side note.
So I spend a lot of time looking at the media's coverage of the crowd. To me, some of the most valuable contrarian indicators are the stories that the media is writing about the trend, about the magnitude of what is happening, because once the crowd behavior is the news story, we're getting pretty far along in the trend. And so that's what I'm watching, and I will often watch the progression of the news story as it moves from section C, page 86, to page 15, to the front page, to ultimately the upper right-hand corner of the front page. And so it's as much what's the crowd doing but again, it's that point where the crowd behavior, the crowd belief system is what is so noteworthy to the observers. The front page is the most expensive real estate in the world, particularly in things like the Journal and the Financial Times, and when they're all screaming the same headlines, that's telling me that we're about to jump the shark in whatever it is.
Part of the etymology or breakdown of the word confidence is con, and I feel like we should address that in the context of the cryptocurrency space broadly, the scams, but really in particular around SBF. Now, I have not tracked it anywhere near as closely as a lot of people on Twitter, but it is, I think, an interesting reminder of the idea that you can be very easily conned by somebody who's overconfident, and yet that person who's overconfident, you want to be around, you want to invest with, because you get tied up in their infectious belief about the imaginative future. To your point, Peter, I wonder how you just your take on very smart people that got caught up in the FTX saga. We've seen this many times before. The smartest guys in the room end up doing the dumbest things. But why is that?
Well, so a couple of things. Social standing is a big aspect of what we've seen so far. Whether it's Theranos or these other things, we're ascribing omnipotence to people who are socially well connected. We're also being smitten by personality types. And so there's this caricature, and I don't mean that in a pejorative sense, but just this image that we have of who are the geniuses in the room today, and that changes with all cultural norms. But I also think we need to appreciate the more confident we are, the less we pay attention. It's hard to be deceived when you weren't paying attention in the first place. And I feel that way so much with so many of the things that we've witnessed that have just violently collapsed in value. Moments before, nobody was paying attention. I mean, there was just no level of due diligence, no level of scrutiny, and those that did even the slightest bit, you talk to some of the short sellers who've been, just sort of waiting for these moments to arrive because they did just some basic due diligence and realized there was nothing there. But I think we need to appreciate that the magician's art of illusion requires a cooperating audience. That you cannot be successful in the world of illusion without a easily distracted audience, and that's what this environment of confidence has provided to so many individuals. And I think we need to appreciate that what we've seen so far is just the tip of the iceberg. I mean, I hate to be a bit of a Debbie Downer, but I think illusion has become a required skill for so many business leaders. If what we've seen so far is just the start of this, I think we need to anticipate that there's a cultural flaw that transcends the C-suites of most businesses today. I think we're likely to go through a period of what I would call disinnovation, that we're likely to be frightened by the consequences of innovation that we've experienced so far. And so you'll see a cultural swing away from futuristic abstraction to a need for things to be tangible, to be concrete. So a swing towards solving real problems in real ways with a clear sense of certainty and control to them. And so I think that a lot of the backlash that will arise will be a sense of, look at the ways technology has made us vulnerable, and now what are we going to do about it? People ask, how do you use this knowledge in a way that's powerful? And I like to say the best opportunities come from identifying where people feel vulnerable, particularly large groups of people. And if you went back to March 2020 and said, okay, how do people feel vulnerable? Well, then you saw a lot of what then became things like supply chain rethinking and onshoring and just-in-time management. And so what I would say in terms of technology is, I would begin to be coming up with a list of all of the ways technology is making people feel vulnerable. And the bigger the crowd and the bigger the vulnerability, the greater the opportunity ahead will be. So I have a couple of thoughts on the Fed, and I'm a somewhat of a Fed agnostic. Just a couple of things behaviorally. The Fed is a following the crowd organization, as are all policy-making bodies. Remember, this is a committee of people that have to come to a consensus agreement in order to act. They will always act after the crowd every turn. The notion of a preemptive, bureaucratic organization is ridiculous, and that is, I would say that, with respect to all central banks and most monetary and fiscal policy agents overall. So I think, with respect to the Fed, I think the most helpful way to watch them and what they're doing is to always remember they are reactionaries. They are responding to the way the crowd feels. Remember, too, the heads of central bankers, the heads of central banks, have typically made a career out of being incredibly in sync with the mood and beliefs of those that they've interacted with. These are master connectors, master, social integrators. And so again, the messages that you're going to see are going to be more often mirroring of mood than they are challenging of mood. So take the individual names out of it, take the individual organizations out of it, just appreciate that these groups are in the business of responding particularly to extreme behavior. And they are as vulnerable as retail investors are to believing the trend will continue. The other thing that I would say, particularly with respect to the Fed, is they are also historians of past vulnerability. And so, sort of like a individual who's experienced a traumatic event, but they remember when the organization was most vulnerable. And the vulnerability that they remember was the late 1970s. And so in their mindset, in their behaviors, is this connection to a moment of extreme vulnerability and a modus operandi that says we can never let that happen again. So when you start to think about inflation, they're they're like a victim of trauma. They're basically, when you say inflation, they have PTSD and say, we must do something to make sure that we squash it like a bug. And so I have long believed that the Fed was only going to overreact to inflation because they have in their, just sort of their body, this sense of, dear God, we cannot allow what happened 40 years ago to happen again. I think one of the consequences of our technology environment today is that everything is recorded, is transmitted, is videoed. And so the scripting that a lot of leaders have to prepare for anytime they open their mouth has really changed how people lead and manage, whether it's governments or businesses. And so, you ask about authentic leaders. The most authentic folks I see these days tend to be sociopaths. They're just being who they are. But I think for a lot of other leaders, they're choosing silence because they're almost recognizing that if they open their mouth, the backlash is intense. And I would put that across the private and public sectors these days. The leadership courage is in short supply because technology enables everything to be re-edited and amplified and used and weaponized back at them.
I would add, I also don't think it's possible as a political leader to be elected with humility. I mean, I do think there is an element of just kind of overconfidence, and again, the sort of seductiveness of somebody who talks very strongly about what that person is going to do that makes them more likely to get voted.
Yeah, I mean, there's no question that leaders today to be elected, you must be a mood mirroring policymaker. But having said that, you can also see just in the popularity of political figures what the mood of the crowd is. I've got a chart in my upcoming book where you can really see how mood drives the popularity of individuals. It's striking. One of the things that I think we underestimate right now is the potential for grassroots leaders like we saw, in the late 60s and the 1970s, come to the fore. And I do think you'll start to, where authenticity as opposed to communication skill is what drives the crowd's attention. And when confidence is low, we do demand true authenticity, and that's where local community leaders have such an advantage over a lot of national, if not global figures. I'm not going to be specific to crypto, but one of the things that I've observed in these phenomenons, many manias attract people who otherwise feel vulnerable in life. And so, I have said this a fair amount, that we have 5 responses to when we feel incredibly vulnerable: fight, flight, freeze, follow, and fuck it. I would not underestimate the importance of followership in identity, and what I think is unfortunately become almost an existential issue for folks involved in any one of the different manias that I've observed. And so it becomes a psychological position where if this isn't true, that then draws into question a whole bunch of other things that I really am not prepared to contemplate. And so I think we need to be sensitive to the fact that there are individuals who are likely to experience real crises, not forget the financial piece, but psychological crises if things do not stabilize in any number of these imaginative, abstract investment worlds. People will bark at me, but I think we have to appreciate that many of them have attributes of cultish behavior. And those get bad names, and you're calling this a cult and that a cult. They say no. I'm just saying the behaviors are very cultish. They are dominant leaders, people who are following in expectation of immense reward, and we just need to recognize that. Sadly, cults don't end well.
That point about vulnerability, I think, is important, and it's unfortunate, right? That you can argue increasingly there's maybe more and more people feeling more and more vulnerable, which makes them gravitate towards the soothsayer on the hill, the narrative, the story, the way out of that vulnerability. Part of that is related to societal aspects, but also I'd argue it's also around inflation and a growing wealth gap. If I'm right that there's a trend towards more and more vulnerability, it seems like we're going to have more and more of these bubbles that just keep on happening over and over again in probably shorter time frames.
Yeah, I mean, I think we need to recognize, Michael, that environments of vulnerability, particularly extreme vulnerability, are also the feeding ground of predators. And when you combine vulnerability with predators in the financial markets, again, you have this Caligulan outcome, and it just sickens me to think of the number of people who have been victimized by the predators of the world of finance in the last couple of years.
What would you recommend people read? What are some good books on on the psychology of confidence and how that might relate to markets. I mean, I'm a huge fan of behavioral finance. Obviously, that's an offshoot of it. But if we go back to sort of just the psychology of confidence, what are some of the go-tos?
Well, obviously, folks like Kahneman. I'm a big fan of a book called Scarcity by Elder Shafir and Sundal Mullainathan. Scarcity, why not having enough matters so much. I just butchered the title, but I think it's a really helpful book to get in the mind, to get inside the minds of people, whether it's in this sort of this post-COVID environment or dealing with inflation. Scarcity of what matters to us really has a supersized impact on us, and it's why why gas prices are such a super psychological supervillain in my book. So anything that you can do to understand vulnerability more.
I think that's great for the audience to be aware of. Again, everybody, please make sure you follow Peter Atwater. You'll see a number of his great tweets. Peter, any parting thoughts here? I mean, I'm confident that nobody knows what tomorrow brings, which means I'm, oddly enough, I think, humble despite all of my few understand this tweets, which is more a joke. But how do you get just any kind of thoughts on how should one think about not getting overconfident? How should one think about controlling the self?
Yeah, so I always like, if I'm making an investment decision, to just quickly ascribe, what are the odds that I've put on success? Because we tend to only buy those things that we believe are going to go up. And just to challenge yourself that, as you stray more and more from 50-50, what that's telling you is not whether something is going to be successful, but just how confident you are. And, I always encourage folks, if you get much beyond, 70-75%, you're kidding yourself. And the same way in terms of selling. And sometimes it's helpful to just do the same exercise. Where do you think the crowd is? What are the odds the crowd is assigned to this? Because ultimately your price is going to be driven by their behavior. So the more you can understand the intensity of the crowd's optimism or pessimism, the better you can play into it, benefit from it on its rise up, and certainly, play it on the way down. But just to appreciate that it's their behavior that matters to you at the end of the day. And so it's their psychology that you want to focus on more than your own.
Very well said. Thank everybody for joining. Please make sure you follow Peter Atwater. I will be doing, as usual, another space tomorrow. Thank you, Peter. Thanks, everybody.